Good morning, and thank you for joining us. I am Simone Rosario, Strader News business correspondent, and we are talking about inflation today. We are minutes away from the Consumer Price Index releasing the latest numbers for July. This one is going to be incredibly critical given we are making every single measurement about what is the Federal Reserve going to do next. Of course, we are coming off of the heels of a pretty disappointing jobs report and even calls out there for the Fed to do an emergency rate cut given the rise in unemployment. This inflation number today is going to help advise us a little bit more as to what we're looking at. And I am joined by the econo queen herself, Kathleen Hays. She is the editor in chief of Central Bank Central. Kathleen, I'm stoked to have this conversation with you this morning. We're looking for July's numbers. The expectations, I'll just lay it out there, are a 0.2% rise on the month and staying flat at 3% inflation for the year, where core is expected to tick down a little bit from 3.3 to 3.2. What are you looking at today? What are you looking for?
Well, basically, I think just the monthly number, because if you're looking at year over year numbers, which of course the Fed always talks a lot about, as opposed to just the monthly, smaller monthly number maybe means that these year over year numbers look a little bit better, maybe a little bit better than expected, a little bit larger on the month, can skew that in the other direction. In terms of what inside the report, people are certainly got their eye on airline fares. I've been trying to book a couple of big flights for the next couple of months. Doesn't look to me like they come down, look like they've gone up, but those are supposed to continue to ease up a bit. Car prices also perhaps looking a little bit better, but I think it's just the number itself, because we know that Fed people have said over and over again, they need to be sure that inflation is heading sustainably towards 2%. Where it is now is still above the target. We're talking
Right.
about the CPI. That's not exactly the PCE core, but that's, I think, we're going to look at, because there's so much writing on this, especially against the backdrop of a labor market that people think is softening.
So, last inflation report for the CPI, we actually saw deflation for the month, negative 0.1%. That was a bit of a surprise for us to see. When we're looking right now at an expectation of a rise of 0.2%, do you think that is a good pace for the Fed?
I think they'd be much happier. They'd be more convinced that, yeah, it's time. We're going to do that September cut. If you got a 0.1 or even flat, if you got another
Mm.
minus zero point 0.1, I think everybody's thrilled with that. And again, then you translate that into the year over year number. Zero point 0.2 is probably in the ballpark of saying, okay, inflation has come down. It could go down further, and we have another couple big inflation reports to look at. I think it's more or less where it needs to be. But the Fed is going to like if they see a lower monthly number than that, even though they're going to put it all together. They're going to look at the yearly rate. That could be significant.
We've got less than a minute to go before these numbers come out. So I just wanted to ask you before that happens, depending on what this looks like, do you think that there's any chance that the Fed isn't cutting in September? Do you think that there's a chance that the Fed will cut before September? Will this influence anything? Or are we on a pretty strong path for a September cut right now?
I would say we're on a reasonably strong path. You'd have to see another number of CPI that goes up on the month, and then maybe sends that year over year number up. A cut before September, I couldn't believe it when people are talking about cuts like that. 50 basis points, 75 basis points, because the stock market had a really bad day or two. No, the Fed is not at all primed to do that. It would send a sense of panic, and markets have really settled down again. However, the possibility of a hike at this point, unless you've got a very much stronger job report and some numbers that are going in the wrong direction for a couple of months, it seems like the path is pretty much open now through the September cut, probably 25 basis points.
Okay, Kathleen, the numbers came in. So I'm going to go ahead and look down at my laptop here and read for a little bit. We've got an expected climb for the month, 0.2%, just as expected. You said that the Fed might have liked to see something even a little bit softer, but what is softer is that annual number at 2.9% inflation year over year. We're in the twos, Kathleen. I just want to let that sit in for a second. I know that last month was on the official level like 2.97, rounds up to 3. But this
Hmm.
is a big moment to see that two in front of all of this. And then if I look at core did exactly what economists expected. It rose 0.2% on the month, and it is up 3.2% on the year. Yep, got to look over my spreadsheet right there. 3.2% on the year. Core, of course, is what strips out food and energy. Those are the more volatile food, indexes out there. So it's looking more at the commodities and services that take all of that out of account. So it is a little bit higher. Do you have it in front of you, Kathleen? What are you seeing?
Well, I'm having a little time difficulty with my system right now too. So I'm so glad you are a thorough reporter on all of this. I think the 3.2% year over year number. Now, remember, let's point out something for everybody who isn't as fanatical as we are about all these numbers. The
Right.
CPI, Consumer Price Index, is right up there with the core deflator, the PCE deflator, I should say. The PCE deflator is running in a lower level than the CPI. The 3.2% is definitely on the CPI still kind of high, but
Mhm.
we got the now I can see it finally. I can see the latest number. No, I don't see the latest number. Anyway, for some reason my BLS feed is not very good this morning. But now I can see it. The CPI for all items 0.2% in July, and shelter costs were actually up. That's a bit of a concern because people
Mhm.
are waiting for implied rents from the mortgage you pay, et cetera, to soften up. I think this is striking me so far as a report that is fine. And I think the Fed right now is more divided on, as much divided, I should say, on the labor market, right? What is employment doing?
Mhm.
It shot up. It's a legit number. In terms of inflation, I would say certainly if you're a Dove, this is a good enough report to say it's going to continue to come down. Don't worry, we can cut in September. Policy, if you look where the funds rate is, the key rate for the Fed, it's still restrictive, and we're making enough, even if it's slow progress on inflation, to make that first cut in September.
This is very slow progress in the sense that we've been hovering around this 3 to 4% range for such a long time. I was looking back over all of the dates to make sure I had everything correct before this morning. And we've been at this target range for this Fed funds rate that we talk about when we're talking about whether they're going to cut rates and when they were hiking rates. And this is basically acts as a benchmark for what ends up being all of the consumer interest rates. So this is critically important. But this high range, which is the highest it's been in more than 2 decades, we've been sitting at it for more than a year now. And
Well,
to keep this
I'm
this
so glad you're
high for
saying that.
this, yeah, go
It's
ahead.
something like, I think it's now 42 months that the Fed has been above its 2% target. And Jay Powell keeps saying, and I know he means it, and everybody at the Fed, yes, we very important, we have to hit the 2% target. But I think you're very smart to point that out, that it's a very slow decline. And now it's at a level where it seems to have gotten kind of stuck maybe. And the
Mhm.
fact that it is still above target, it matters to certainly the more hawkish people, I think, on the Fed Open Market Committee, those Fed officials that think, well, I'm not quite sure it's time to cut, and still worried that the labor market hasn't softened enough to be convinced that that's going to gradually take more of that kind of pressure off the economy, demand, wages, et cetera, that are going to feed through to the inflation numbers and help bring it down. So again, this is the kind of number, you just mentioned the possibility, what if they don't cut in September? And there's a couple more big numbers. We've got another employment report. We've got a
Mhm.
couple more inflation reports. So I think you're smart to ask that question because maybe it's not completely off the table. I don't think, I think it's on if inflation gets worse. But at this point, the idea that their question, well, could they maybe just pause? Most people I've spoken to don't think so. Although when I spoke to Rob Kaplan recently, former president of the Dallas Fed, now back as his executive perch at Goldman Sachs, he thinks they'll do the 25 basis point cut in September, but he doesn't think it's going to be the beginning of a series of cuts necessarily. People say, oh, and once the Fed starts cutting, they always do several in a row, right? And he thinks that they'll do one and then they'll look and they'll see what the numbers are doing and they'll see on inflation, on jobs, et cetera, and they won't necessarily
Mhm.
do extreme cuts that people are looking for. I think another point you raised 50 basis points. Well, quite apart from what the stock market's doing, I think there are people, for example, at Citibank, that team, those economists think that they'll do 250 basis point cuts because they're behind the curve now. If you see inflation not improving more, wouldn't it maybe be more prudent for the Fed to say 25 basis points is fine, do that cut, see what happens next?
I would agree with you. This inflation report right now makes the Fed look a little bit smarter than they did when the employment report came out. That jobs report, that they expected unemployment to be at 4.1%, and it spiked up to 4.3%. It triggered a recession indicator. It got a lot of people talking, and we've been covering this extensively since that happened. But that jobs report came out 2 days after the Fed made their rate decision, which was to hold steady. They weren't convinced that they were seeing what they needed to see in the data. And now we have this inflation report, which is mostly as expected. Of course, the only thing that wasn't just as expected was a slight tick down in that annual rate of inflation at 2.9% for headline. And that to me would mean that basically energy prices a year ago hadn't moved as much as they thought it had, and it hadn't this month, because right now energy prices for the month were flat. There was a big drag down for energy prices last month, which is what helps the
Hmm.
inflation rate back then. But yeah,
Yeah.
looking at this inflation report, seeing the 2.9%, I'm getting excited because we're seeing a two in front of it for the first time. But to your point, it is the headline number. It is not the core number. The core number is higher. If we look at what the Fed actually looks at more than the rest of us look at the CPI, they look at the PCE a little bit more, which is a more all-encompassing basket of goods from their point of view. And that was sitting at a 2.6% for core so far. So that is definitely much closer to the Fed's 2% target rate. But
Yeah. I mean,
you
overall,
you
if
you
you,
talked you talked about this, Kathleen. Sorry, I just wanted to ask you about this because there's just been so much conversation about how much the Fed is going to cut. People are throwing out 75 basis points. This inflation report does not point to that.
oh heavens, I don't think anything pointed to a 75 basis point emergency rate cut because stock market had a big decline. And then, of course, the yen carry trade blew up after the
Yeah.
BOJ made its rate hike that was not entirely expected. So that kind of, they all fed together. It was a confluence of forces. And one of the people I spoke to said that these calls for 50 basis point cuts, even 75 basis points, kind of smacked of investor entitlement. Oh, if things are going bad,
Mhm.
going against us, Fed has to hop in and do something. So I think 75 basis points was more out of that ruckus, that big stock market carnage, if you will. In terms of the numbers, I think that seems to me the Fed is moving slowly. Mickey Bowman from the Board of Governors in the last few days said she's not convinced it's time to cut yet. She thinks the labor market still looks pretty strong. Raphael Bostic, who's president of the Atlanta Fed, just in the last couple of days, said, well, he's sure they'll cut rates by the end of the year, but he doesn't think they're necessarily there yet. So I think this report today, well, I could say, who else? Mary Daly in the last week or so, president of San Francisco Fed, saying that she does think they're going to need to cut in this last part of the year. It's just a question now of when they start and how much they do. Hearing those kinds of things, I think, does that mean they're going to do 50 basis point cuts? Doesn't the more cautious, gradual
Mhm.
25 basis point cut get you there? If suddenly the labor market starts looking a lot weaker, then you could say, well, that could mean they would speed things up. But even Austin Goolsbee,
Yeah.
the president of Chicago Fed, who's one of the more dovish people on the Federal Market Committee, still says, yes, they need to cut. Policy is restrictive, and there's a concern if they wait too long, the labor market will really start weakening. But I think they're more in this middle of the road boat when you put them all together. Or middle of the road boat. That's kind of that's kind of a contradiction. Lane, I should say.
Unless it's
Anyway,
flooding.
I would say, to me, stepping back, not hearing what anybody else is saying yet, and I'm always interested to hear what various economists and Fed
Of
officials, et cetera,
course.
are saying as well. But what do you think? I mean, do you think the door is open to 50 basis point cut?
At this point, like I said, I think that this report makes the Fed look smart in its pause and its hesitancy to cut in July. I think that July was a number that, people who thought the Fed should have been cutting a while ago were certainly pushing for July, but not a lot of people were. Everybody was really targeting September until that jobs report came out. And then it was like, oh my gosh, why didn't the Fed cut in July? Having an inflation report that is basically as expected, to your point, the shelter continuing to be pretty strong, it makes it seem like last month was a little bit of a fluke when it only rose 0.2%. Now it's back up to its rising 0.4% every single month, which it's been doing except for last month for some time now. So 50 seems pretty high for me. And we're looking at a Fed that has been incredibly cautious. That said, we do have quite a bit of data between now and September.
Sure do.
What does that jobs report in less than a month look like for the Fed to have more urgency? Do you think it's going to be another bad jobs report, or do you think that's going to stabilize a little bit?
Well, jobless claims just came back down to 233,000, and I think what's very important. I don't know if everybody focused on the BLS, Bureau of Labor Statistics, and a very important number that they sort of downplayed in that report. We know that the unemployment rate jumped up to 4.3% from 4.1, and we know that it wasn't because necessarily people were losing jobs. It was because more people were coming into the labor force again. And when you start looking for a job and you don't have one yet, you're kind of unemployed. I think even more important is the fact that the number of people who could not go to work because of weather, and that's a
Mm.
category in the BLS numbers. It was up over something like 460,000 in July. That month usually averages about 40,000. So many people have looked at that and said, maybe that's one of the reasons. Yeah, that was the week of the hurricane, right? That we got that jump in unemployment. Maybe that affected payrolls. We don't know for sure, but I think that's one of the things will be very interesting to see. Does the labor market, via the next jobs report, look like? Yeah, it's not. It's as someone say, normalizing. As former St. Louis Fed President Jim Bullard said to me recently, he thinks you're getting more to the natural rate of unemployment. The 3% employment, when it got that low, was kind of abnormal, right? And this is now more of a normal rate of unemployment. He's convinced that the Fed will do 25 basis points in September. But remember, he was calling for that at the beginning of the year. He thinks they need to get less restrictive, and they can do it gradually. So, John Taylor told me, John Taylor from Hoover, from Stanford University, that he thinks the funds rate needs to get down to about, according to his rule, the Taylor rule, to about 4.5%, maybe 4%. And they could do that with two 25 basis points cuts and a 50 basis point cut. But when I think that they're going to need that July weakness in the labor market is going to have to be verified by the August report. If it isn't, it seems to me that's going to be the perfect opportunity for them to say, yes, we know we can start cutting now, we can start normalizing, but 25 basis points at a time is enough.
Is there any chance that they don't cut? Let's say, to your point, we get the next jobs report and it has normalized, and this last month was a fluke. Then you
Well, I
get
think
another
we'd have to,
inflation report like this. Is it convincing?
I think my bet would be that they'd have to see another inflation report that is not as good as this one. Okay, that yes, this one is made some progress on the headline. You can look at the monthly numbers as well, but I think it would take something that looks like it's pushing inflation back up again for them not to cut now. The door's wide open, but thank goodness we've got Jay Powell at at Jackson Hole next week, and giving his all important Friday, opens up that whole Kansas City Fed Symposium conference Friday morning. This is his opportunity to send us a clearer message on some aspect of what the Fed is thinking about. He doesn't have to do that. I don't think it's going to be just looking at the economy and inflation. He'll probably put this in a bigger context. At the same time, I think people are going to be waiting for him to just give us a little more guidance on where you're leaning now.
While we're talking about this, Kathleen, you are going to be in Jackson Hole. During that speech, you're going to be talking to people on the ground there. How can people listening right now, how can they follow your work while you're over there?
Well, you can. Thank you very much for asking. You can go to my Substack. I'm on Kathleen Hays Presents Central Bank Central. I'll be posting things throughout the day on. Well, actually, I'll be starting on Thursday with a big preview with Jacob Frankel, who is a former president of the Bank of Israel. He was at J.P. Morgan for many years, and he's been going to Jackson Hole since from the very first meeting practically. So it'll be great to get his setup, which I'll be posting on Thursday. And then I've got various people lined up on Friday, including former presidents of the Federal Reserve Bank of Kansas City, and that would be Esther George and Tom Honig, some other people I've lined up as well. So thanks for asking. Yeah, just I'll be posting all day long, so you can just hop in and take a look. And I'll be posting on Twitter and etc.
Perfect. And that's Kathleen _ Hayes on Twitter as well, and always on your Substack. Let's talk about, looking into the tea leaves a little bit more with the inflation numbers. Yesterday we had a very soft and pleasant producer price index come out. It was 0.2% rise on the month, which is equivalent to what we're seeing here in the CPI. And that annual inflation is 2.2%. So this is, the consumer price index, just what it sounds like, the consumers. The producer price index, just what it sounds like, the producers. So this is the cost of goods before it gets made or assembled or sold off to us. So knowing that that is coming way closer to 2%, what do you make of these numbers?
I think it's good sign. They have come down. In fact, I think they were flat on the headline, or up on the headline and flat on the core, and the year over year number, one of them moved up by about a tenth. It's moving in the right direction. Remember, producer prices are wholesale prices. It's the secondary report, in a sense, to consumer prices. It's more heavily weighted towards goods than services in the PPI. CPI and wholesale is more what I'm trying to say about PPI. CPI is retail, is what we're paying at the store. It's an important secondary number. The PCE core, which we're going to get, is going to be the one to sort of cement what we're seeing in CPI. Some gradual progress. Maybe it's not falling quickly, but at least it's not going up, and it is showing signs of key elements going in the right direction. But again, I think when we get back to, this week, we have retail sales, we have
Hmm.
industrial production, because remember, CPI obviously is so important. That's why we're both here. In terms of, it used to be, remember when the jobs report was the big one, big Friday, the first Friday of the month. Then, and I think that the employment report is coming back on an even footing now with inflation, because it
Yeah.
seems that most investors, most Fed officials are satisfied that things are moving in the direction, even if slowly. And the ones who are worried of the fact you're going to see all of a sudden that this restrictive 5.25 to 5.5 is hitting the economy. That's what's in the balance, and I think that's why the cautious Fed will say, let's go ahead and do the 25 basis point cut in September, unless we can unexpectedly get some crazy CPI number that makes everybody start worrying.
Yeah. Okay. So let's just level this out where we're at today. We're putting to bed any kind of blasphemous cries for an emergency rate cut. We didn't get to
Yes.
talk about this because, luckily things are coming in as they were, but emergency rate cuts are really reserved for very dramatic occasions. I mean, we did it a couple times during COVID. That's an example. The Great Recession. Like, these are emergency rate cut time periods versus, to your point, the stock market going a little haywire for a couple of days. This isn't the dot-com crash. So we're putting to bed the emergency rate cut. And now, when we're looking at what size rate cut we could be looking at for September, we are going back to what was conventional thinking for a long time until that jobs report, which is a 25 basis point cut in September. Let me pose this to you. We've seen mortgage rates go down to levels lower than they've been in more than a year. This is done in anticipation that the Fed is going to be cutting rates. So when the Fed does cut its rate, how are people going to be affected? Are rates going to come down even more? Has the air already been taken out of the tires because they're expecting the cut? What's happening there?
Well, of course, we had the big bond market rally, so that's pushed yields down a lot, and that was one of the things, of course, that intensified after we got the Powell, the Fed decision, and then the unemployment rate going up, et cetera, making people that much more worried about it. And of course, that's the direct link between mortgage rates and the bond market, right? The 10-year note yield, when it goes down, you're going to see mortgage rates come down too. I think that's a very, on a human level, like, doesn't anybody know somebody who's trying to find a house and they can't because people still don't want to move out of their low mortgage rate mortgages? They don't want to sell their house yet. Doesn't anybody want to sell their own house and they figure, well, I don't know, the
Yeah.
mortgage rates are so high, maybe I'll wait. The part of the issue with the how much home prices will come down is the fact that inventories are low, and when the Fed cut rates
Mhm.
so much during the pandemic, there was a huge bout of home buying, and that's another reason why, even with somewhat lower rates now, mortgage rates, that is, there's the home sales are not up that much yet. But I think it's a very important factor right now, right? That if the more yields come down, the more mortgage rates could. I mean, Now, if someone could get a 5.5% mortgage, they would snatch it up, right? And when the rates
Yeah.
got so low, oh God, if I had to pay 3.75, So it's a very powerful thing that could happen. And as the Fed starts cutting rates, presumably, yes, bond market will rally. You'll get yields coming down more, and that's going to fade through and be a very important factor. So that's in the kind of in abeyance right now, but uh, it's it's a little bit complicated, and it's a very the home prices are much higher than they were. Home affordability is so much worse than it was,
Right.
partly because of what happened back during the pandemic. But it's something to look forward to. And in
Mhm.
terms of the housing industry, a lot of calls for we need more homes now. That's the thing. We need more construction. Well, if I'm a contractor, if I'm a developer, if I'm a builder, if I can see mortgage rates coming down, presumably that would encourage me it's going to heat up the market, and it's going to make more sense for me to do that.
Hmm. Yeah, and I just want to point people that are listening. We just did a story this week on housing affordability at san.com where we go over all of this. And to your point, Kathleen, I do take a chart and zoom out to show people that, pre 2000, even the rates we're at today would have been an absolute steal. So it's all about perspective when it comes to that. And I agree with you now. I think when mortgage rates were climbing up, people were thinking 5%, there's no way. Now, if you could score anything in the fives, you'd snatch something up right now. But to your point, we talk about inventory, we talk about all of this. And the interesting thing about how housing really plays into what's going on with the inflation story is there's a little bit of like a double-edged sword going on right now where rates are high, so there's not a lot of inventory, there's not a lot of movement in housing, and housing prices are staying pretty high because there's not a lot to choose from. Yet inflation is being kept high in large part because the shelter index is so high, because people are spending a lot of money to keep a roof over their heads. And so it's like, which one's going to give first? But we just love to put into perspective what these rate cuts mean for, people who aren't just doing what we're doing every day, which is talking to economists and trying to navigate and predict what's going on in the market. So I appreciate you being able to talk to us about this one. And again, mortgage rates right now, the lowest they've been in a year. And inventory is going up because people are getting restless. They want to start moving around, even if it does mean ditching that old interest rate and getting something else. They do see the decline on the way. Kathleen, anything else that you wanted to touch on before we let you go?
Let me think. Gosh, I think that watching, I think this Jackson Hole speech potentially is very important from Chair Powell in the past. I mean, years and years ago, because I think it's been going on now. Is this 40 years for this Jackson Hole conference? That's the Kansas City Fed Symposium every year. It was when the Fed chair speak on Friday morning, it would just to be to kind of welcome everybody, kick things off, maybe talk about the economy, just and then get on with this a morning long series of papers and presentations and panels. And of course, there's all kinds of big central bankers, former central bankers, all kinds of people in the audience, and not just from the U.S. and around the world. And then there was a point where, over time, the Fed chair would use this Jackson Hole speech to deliver a message. And as I recall, Ben Bernanke, when the first QE, quantitative easing, had been done during the great financial crisis, he signaled QE2, right? That was a big thing to put out there. And he didn't exactly say they were going to do that, but he opened the door wide. And Janet Yellen has used it that way. And Jay Powell
Mhm.
has given some very important speeches there too. And it seems there's so much riding on this meeting, this September meeting. Everyone is watching it. And it's not just important to the US, it's important to other countries, right? I was speaking to someone recently who's been going to China and consulting people there for 15 years. And he said how pessimistic everyone he talked to was. And as he says, as soon as the Fed starts cutting rates, the PBOC is going right behind them. And of course, if the Fed is cutting rates, that takes some pressure off. It makes it a little bit easier for the Bank of Japan to do what it's got to do. Emerging markets. This is not just about us. And the Fed never makes policy for the rest of the world. I believe it when they say that. But if you are the rest of the world, and you'd like your rates to come down, it does make it a little bit easier, particularly in the emerging market developing economies, because they often have to watch their currencies very closely, right? Because if you cut rates, what if people start selling your currency? That can be a problem too. So I guess that's what maybe that big picture I'd like to leave everybody with.
Mhm.
And again, that this is, we know the Fed's going to be cutting rates. We know they're going to normalize. It's more of a question of when and how much and how fast, unless something crazy happens, like all of a sudden the economy's super strong. All of a sudden, inflation starts rising. But I thought we've been talking about that the whole time. So it's a trend that's underway, and maybe as we follow it, you and I so closely, investors, traders follow it so closely. There's more of this sense of urgency. Oh, one more thing we haven't even thrown in here. Some people say, if it works for the Fed's favor that they don't really need to cut in September, that gets them out of a point where they're going to be accused, whatever they do, cut or no cut, one party or the
Yeah.
other is going to say they were trying to help the other side. So that, I don't think they're going to let that drive them. But that, in some sense, might be a blessing in disguise for Jay Powell if he could just sit back and say the evidence isn't quite there. See you in November.
Yeah, I mean, for the economy, I hope that's not the case, in the sense that if the evidence weren't there for a September cut, that would mean that we're not making progress on inflation. And we've been waiting a very long time to be able to get over that hump and to be able to get into the twos and see us getting a lot closer to see that finish line in sight. So for the sake of the economy, I hope that's not the case. To your point, after this September meeting, the next meeting comes in the week of the election, the 2 days
2 days
following
after.
election day.
Yes.
So, quite a pivotal time there. Let me ask you this. You're going to be in Jackson Hole with this big speech that Fed Chair Jerome Powell will make. What are we going to hear from him that is different from what we hear in the FOMC press conferences?
That's a really good question, because in the press conferences, he gets hammered with questions. He will not be taking questions in Jackson Hole, number one. Number two, I wonder if he'll want to put the inflation that's been experienced, where the Fed is now and where it's going, into a bigger framework of, it was a tricky time, and there were supply shocks, and one of the supply shock was the labor market. There weren't as many people there, and so wages went up. Now all these things have happened, and we are now, and somehow give us this broader sense of how they're looking at things now, right? Could he talk about the neutral rate, right? Are we closer? Do we have to? Is the neutral rate up or down, et cetera, et cetera? What are the metrics they're looking at? One person suggested to me that he thought they could look at the upcoming framework review, which is going to start sometime in the fall. Remember, they changed their framework just when the pandemic was starting, to say we have to see maximum inclusive employment before we would hike rates, and we'd have to see inflation at or above, I believe it was 2.5%, and rising before we would start hiking rates to bring it down. Some people think that was one of the reasons that they moved so slowly, too slowly, slower than they should have, to start hiking rates when they did. And maybe that's something he'll address. I myself think keep it pertinent. He's going to keep it more in terms of what everybody's trying to figure out right now, and give us, again, more of a framework, a bigger sense of
Mhm.
being willing to move slowly. I'm not sure, but it's up to him. And I think after all the emphasis we've seen here, and the market upheaval recently, it will be kind of behoove him to help us all understand better where they are now and what's going to drive their coming steps, and maybe even cool off some of the idea that there'd be any emergency cuts because markets go crazy for a day or two.
It would be interesting to hear him put this journey into perspective. It's been a tough one for people out there to live through, a peak of 9% inflation, to continue to see inflation, for it to take so long for it to come down. We're sitting here right now with a headline number of 2.9%, and that looks incredibly promising when you look back at what we've been through to this point. So it will be interesting to hear if he puts the last several years into perspective, given everything that the economy has gone through since the COVID-19 pandemic. We're going to leave it there. Kathleen Hays, editor in chief of Central Bank Central. Your expertise is just bar none, the best that we can get in moments like this for us to be able to hear what you're thinking about these and to also hear all of the people that you're talking to. Again, people can follow you at your Substack to be able to get these types of conversations all the time and here at Straight Arrow News because you're a friend of ours and we appreciate you coming to join us.
Oh, I love joining you. We always had such a great time talking, and yeah, and you obviously you're a dedicated Fed watcher, I know, and I've always been a Fed addict. Once you start it, there's you just can't give it up. It's always there.
Well, we'll keep keeping everybody informed on what's going on, and we hope to touch base with you when you're in Jackson Hole as well. Thank you, Kathleen.
That'll be great. I'll be there, and if the weather's nice, we'll have a beautiful view of the Tetons behind us.
Yes, we'll all be jealous watching you. All right, take care.
You too, Simone. Thank you so very much. It's always a pleasure to join you.